Hey everyone, welcome to this week's stock and macro update. So this week I want to first start off with an overview of a couple more of our stocks in the 21 Disruptors Index. First we're going to go over Energy Fuels, and then second Livent Corp, which is a lithium company, and Energy Fuels is a uranium company. Then I want to touch on the performance overall of the 21 Disruptors Index over the past week versus the overall market. And then mostly want to focus this week on the CPI data that came out last week for inflation and the market reaction. I want to go over that, why it sold off pretty sharply after the data came out. And I want to go over what I believe the Fed is going to do going forward as a result. So just starting off with these two stocks. So uranium and lithium, I think, are two major pieces in the future of commodities in terms of importance, because I think we're going to see nuclear make a huge comeback. It's been kind of forgotten about over the past 10 years or so, especially in the US. And lithium obviously is one of the key ingredients in lithium ion batteries, and energy storage is definitely becoming more and more important as renewable sources of energy grow, like solar, wind, hydro, and many others. And in order to store the energy, obviously when the sun isn't shining, when the wind's not blowing, you need the energy storage so you can store that energy and use it later. So just a very practical use that lithium provides to that. And it has some other uses too, but mostly want to focus on the energy side of things. So Energy Fuels is right now one of only 3 different companies that is actively mining uranium in the United States. It's the biggest of the 3. But uranium mining and uranium production in the United States has come down almost 100% over the past 5 years or so. Back in 2015, 2016, we were still producing millions of pounds worth of uranium. That came all the way down to 21,000 pounds last year. This year, I think it's on pace to be maybe around 33 to 35,000 pounds, but still nothing compared to what we were doing even less than 10 years ago. So I think, with all the geopolitical stuff going on right now, with the uncertainty surrounding energy, massive shortages, especially in Europe, I think the world is going to start turning more and more towards nuclear, because the world was set up for nuclear in a big way in the recent past, just again around 10 years ago or even less. And since then, a lot of reactors and a lot of just power plants in general have been shut down, decommissioned. Even if it's temporarily, we're just not using all the capacity that we had in the past. I think a lot of that is going to be restarted. We're already seeing signs of this in France and Germany and Japan. One of the biggest, actually, utilities in the world, might be the biggest nuclear power provider in the world, is a company in France, and they said they're on track to restart all of their reactors to produce nuclear once again, starting in 2023. So we're starting to see the U-turn now from European countries, Asian countries, and the U.S. actually is starting to finally show more interest in nuclear as well. So in the U.S., I think about 20% of our electricity generation is from nuclear energy. That really hasn't changed too much, but the thing that has changed is we haven't been mining nearly as much uranium. That, I think, is going to turn around for sure, as, again, geopolitical things are a lot more tense and we don't want to be as reliant on other countries, understandably so. And I think Energy Fuels, being the biggest domestic producer, is in a prime spot right now to benefit from this. So the Department of Energy is interested in starting a uranium stockpile sort of thing, and they are now taking proposals from domestic miners. Obviously, Energy Fuels submitted a proposal to this, and I think that they're going to be a big beneficiary of it. The Department of Energy said they want to stockpile 1 million pounds of uranium, and we're also seeing utilities, just like the government. Utilities are also interested in stockpiling uranium, and Energy Fuels is also benefiting from that. They've signed 3 big deals in, I believe it was in May, with they couldn't name the companies, but with certain utilities to provide millions of pounds of uranium over the next 8 years. So it could be anywhere between 3 and 4.2 million pounds over that span of time. So big long-term contract win for them. And I think, yeah, uranium mining, I think, is going to make a massive comeback in the U.S. because we have the resources to do it. We just stopped and we way increased our reliance on other countries. Switching over to lithium, it's really the same situation. We used to be the top producer of lithium in the world with 27% market share. And now we're all the way down to just producing 1%. Actually, I think it's a little less than 1% of the world's lithium. And we have one operating lithium mine in the U.S., which is pretty sad compared to what we used to be. So I think that this is another area we're going to see increased domestic interest in, just so we are more self-reliant on mining our own natural resources. The U.S. obviously is a huge source of natural resources. We have lots of uranium. We are number 4 in the world in terms of lithium resources, and we just have not been using it. So I think that's going to change. Livent obviously doesn't have any mines. The only company that has a mine that's operational is Albemarle. But Livent has several facilities set up in the U.S. to actually turn the lithium into products that are used in batteries and things like that. Their main operations for actually mining are down in Argentina, but I could see them switching and trying to get involved in domestic mining as well. They are based in the U.S., and they also have an interest in Canada, which is another huge source of lithium globally. I think they're number 2 or 3 in the world in terms of reserves. So definitely big steps being made for Livent, and they also recently signed a huge deal with GM, 6-year contract to provide them with batteries for their electric vehicles. They've also been a supplier of Tesla in the past, so they've gotten a lot of recognition from the EV industry. And being a relatively young company, that's exactly what you want to see in an investment. I think their market cap is still below $5 billion, so pretty small company that we're dealing with here. And I think the future is very, very bright for them. Turning to performance of our index, last week was definitely rough. And this is going from Monday close to Monday close. So this is accounting for the 12th through the 19th. The 21 Disruptors Index was down 6.29%. Which is worse than all the benchmarks, all 4. S&P 500 down 4.45%, NASDAQ down 5.22%, Russell 2000 down 3.67%, and ARKK, the ARK Innovation Fund, down 4.73%. So red really across the board. Ours just happened to be down a little bit more than the others, but keep in mind that last week ours was double the 3 major indices that we keep track of as well. So it was a very, very good last week and a pretty poor past week here, but not as bad this past week as it was good a couple weeks ago. The top 3 performers in our index were Enphase up 3.44%, Tesla up 3.13%, and Livent up 0.61%. So those were the only 3 stocks in the index that had a gain for the week. The bottom 3 performers were Ethereum, down 20.82%, Energy Fuels down 12.76%, and Desktop Metals, 3D printing company, down 12.29%. So obviously a very rough week price-wise for Ethereum, but they had the merge that happened successfully, and that was a huge milestone for them. Unfortunately, turned out to be a sell the rumor event, or sell the news event, buy the rumor, sell the news, and I'm going to get into that definitely into more detail in Friday's update, so make sure you tune into that. Now getting into the inflation data. So CPI comes out every month. In August, there was 8.3% inflation year over year. And this is actually down from July that had 8.5% inflation year over year. But the market still sold off. And this is because the headline total CPI number that you see does not tell the whole story by any means. You got to look deeper into the data, and if you do that, you'll see that core CPI, which takes energy and food out of the equation, was actually up 0.6% month over month, which is a lot, and year over year it was up 6.3% in August versus July when it was up 5.9%. So increasing core CPI at an increasing rate. Core CPI is a whole different ballgame than regular because, again, it takes food and energy out of the equation, and food and energy inflation is usually driven by supply issues. So when you've got food shortages, you've got whatever causes shortages in the energy industry, in this case geopolitical things, that is a supply issue that can't really be helped by adjusting monetary policy, which is what the Federal Reserve does when it switches interest rates. So the core CPI is mostly made up of things like housing, retail goods and services, autos, things like that. So when you see core CPI up, it's usually things that are driven by demand rather than supply. That was obviously not the case right after COVID because a lot of things were in short supply, but you could also say that that's because there was such high demand. So it was kind of both. You had the high demand because everybody got stimulus checks, and at the same time, the world was restarting all of their production, and so there was a strain on supply. But I think that a lot of that strain on supply was due to the suddenly high demand out of nowhere. So overall, this means that really core CPI demand for goods and services were up, and that is a lot of discretionary spending. And the way that the Fed treats supply-driven and demand-driven inflation is very different. So with supply-driven inflation, again, they can't really do anything because these are issues that need to be solved by the actual energy producers and the food producers. When it's a demand issue, it means that people are spending too much money. There's just too much demand for goods and services. This is usually discretionary things like retail goods and houses and cars and, again, things like that. That's really what drove inflation in August, which is not what you want to see from a stock market perspective, because it means that there was more discretionary demand for things that the Fed wants to curb. This is what they've been saying all along, is that they are aiming to crush inflation essentially by raising rates, by making economic conditions harder and tighter. So in that case, this really opens the door for them to do that. And if you dive in even further into the data, you can see that overall, the commodities component in inflation, which isn't like natural resources like you would think, but actually commodities in terms of the CPI data means a lot of different retail goods and services. This has a big weighting in the CPI. It's 21.7% of the total CPI, and the commodities component was up 0.53% month over month, which was the second highest reading on a monthly basis in the past 6 months. So that means that, again, people are going out there spending what they would have spent before on higher food and energy prices, and they're instead spending it on discretionary things that they don't really need, but since they have the money freed up a little bit because gas is down, food is in some cases down, they're going out and still spending that money. And this really means that inflation is going to be harder to solve than originally thought, because people are still going out and spending their money, whether it's on higher gas costs, higher food costs, or even higher retail good costs, things that are discretionary. And that is exactly what the Fed is aiming to curb by raising the rates. When you raise rates, when the Fed draws down their balance sheet, which means basically selling treasuries, mortgage-backed securities, things like that, back into the financial system, it means that economic conditions are going to get tighter, and that typically down the road results in layoffs and things like that, and just a overall recessionary economy. In this case, we have such a strong jobs market, which I've covered in several updates over the past month or so. And as long as jobs are plentiful, right now I think there's still like 1.8 to 1.9 jobs available for all the people that are looking for jobs. And that means that people are still earning money, and they're following the money to the jobs that are going to pay them more, and they're continuing to spend that money. And they're also, on top of that, spending a lot of money via credit card debt. So the debt to savings ratio is getting pretty high. I think it's at this point the highest since 2010. And so not only are people spending the money that they're getting from their jobs, They're also digging into debt, which isn't necessarily good when you've got rising interest rates and what looks like the beginnings of a tightening job market. So as long as the job market is relatively strong, I think that this inflation is more likely to stick around than to go away during that time. And I've said before that I think the jobs market is going to be relatively strong for at least 4 to 6 more months. During that time, if we see inflation, especially core CPI, and especially within that, retail goods like the commodities component, if we see that continue to be strong, I think that we're going to see the Fed continue to raise rates, even if it's at a slower pace. So we've got the rate decision coming up. Actually, by the time that you watch this video, it might actually be out already. But as of Monday night when I'm recording this, it is expected to be, I think, a 75 basis point raise. So I'm not saying that they're going to do 75 basis points every single meeting, with the next which is in November, until inflation is back down at like 2 or 3%. But I do think that while inflation is still hot and while the job market is hot, I think that they're likely to keep increasing rates, whether it's, not necessarily 75, but maybe even 25 basis points per meeting, just until we see some big effect from, within the employment market, or, a big hit to consumer spending or things like that. So essentially the Fed, this is a nice way of them saying that they want to put the economy into a recession to curb demand. So I don't think that they're going to stop until we see some signs of that, or until something in the economy breaks like it did in 2019. But either way, definitely want to keep an eye on that core CPI and on the just the overall consumer spending habits, because if energy goes down, sure, that's good for inflation because energy is a pretty decent portion of CPI overall. But if energy goes down and people just spend that money plus even more on other things instead, it's going to keep inflation high. So I think that that's more likely to happen as long as the job market is strong, and as long as that happens, the Fed is going to continue to raise rates. So that's what I'm getting out of this. I hope everybody enjoyed this video. That is it for this week. So thank you so much for watching, and I will see you again with the crypto update on Friday.